Hey everyone, got Rod Crandall here and Andrew Casilius. At the top of the hour, we're going to wait another 30 seconds or a minute to get started as we get the remainder of you logged on. So appreciate you being here and hope you're making it a great start to the year. So if you'll give us maybe 30 more seconds, we'll get started formally. Suppose I'll share my screen up now too, huh? Because it's not on right now, correct, Andrew? My screen?
Your screen is not visible now. Now it is.
Okay, cool. Very good. All right, everyone. Well, welcome. We're just 1 minute past the hour. We appreciate you joining us. This is our monthly coaching call. We call it Coach's Corner. For those of you that are new to us, we want to thank you. We specialize in the intentional integration of insurance here at US Advisors. We work almost exclusively with wealth advisors and help them have better conversations with their clients. And so once a month, we pick a topic. We spend about 45 minutes to an hour on that topic. And today's topic is opportunities in the new tax landscape. And I really hoped that as we're sitting here, I was going to be able to tell you what that new tax landscape is. But we can't. We don't know because it's still in Congress and sort of being mulled over. But as you look at that, and if you have looked at that, you know, some of the things that stick out to me are that this coronavirus relief package has totaled about $5.5 trillion so far and projected to exceed 8.4 trillion. I mean, this is monopoly money. So it's not so much that number, it's that all of our tax revenue is like 3.6 trillion. And so where is this going to come from? I mean, it's my belief distinctly, and the advisors I work with, that it's not a question of if taxes are going up. It's a question of when and how much and in what way. And you're talking about a number of things potentially on the table, including increased marginal tax rates, increased capital gains tax rates. You also have the idea of the elimination of the backdoor Roth conversion, which would affect a lot of our best clients. And so there's a number of things going on. And at the very end of the day, it's our belief that taxes are going up in some form or fashion on our best clients. And at the same time as those taxes go up, really considering opportunities with insurance, primarily because it's one of the most tax favored vehicles around is life insurance, and really understand where do those things fit. And so over the next about 45 minutes, I'm just going to let you see, let you inside on what we see and what I see and where we see the opportunities. And I've got to tell you, without being, you know, overly robust, I think we're going to be in one of the best times ever to place a lot of insurance. Because as taxes go up, that means that the cost of putting money outside of insurance is higher. At the same time, a lot of our costs of insurance have actually come down, and I want to share a little bit with you about that. And so if the cost of insurance comes down and the cost of taxes goes up, that creates an opportunity to really understand how to utilize insurance as an asset class. And that's another thing that you'll always hear from us, is that the average person thinks about life insurance as something that is a necessary evil and that they need to buy the least amount of at the lowest cost. And certainly for a lot of people, that's appropriate. But for our best clients, it's not about the insurance that they need, it's about the insurance that they want. And the reason that they might want it is because as an asset class, it has unique attributes that other asset classes do not have. And so really understanding that gives us the opportunity to have the consideration that we need as we're planning with our clients for the insurance solutions. And so again, I want to kind of let you in on that up front. Before I do that, I want to make sure you guys know Andrew here. His box says Nathan Berglund, the owner of our firm, but you've got Andrew Casilius here. Andrew, do you have any opening comments or anything to add relative to what we're going to be discussing here today?
No, just a second here. I think there's a huge opportunity for life insurance and just these tax efficient, tax deferred strategies. Like you mentioned, you know, the bill hasn't been finalized yet, but we have a midterm coming up this year. So I think some form of bill will probably get passed through. And a lot of these, you know, proposed tax increases, some of the eliminations, I think will probably stick. We don't have a crystal ball, but I'd much rather be prepared than unprepared, to be honest with you.
That's exactly right, and I'm with you. And so hopefully we're helping you be more prepared. And then I guess the last note I would make is, you know, it's January 20th, and I know many of you probably did your business planning. If it doesn't include systematic integration of insurance, it is not too late. And in fact, next month, we're going to do a coach's corner on how you can just bring on 12 new clients this next coming year inside of 3 different strategies and drive $100,000. And this isn't pie in the sky. These are everyday cases. And so we're going to share with you a formula how you can do that in next month's coaching corner, which I have the date, but I think it's February 17th, but I'll let you know that as we move through here. All right, so with that, again, the agenda which we sort of described, what items are being proposed and how can we use insurance designs to align with those? And then ultimately, how can we discuss and utilize and position life insurance as an asset class, right? And so as we talked about, some of the things that I think are most onerous perhaps is this elimination of backdoor Roth conversions. I personally know at least a dozen wealth advisors that systematically are exercising backdoor Roth conversions with their best clients, and they're very likely not going to be able to do that. Sounds like we might have just a couple more years of that. Again, as we described, what's proposed and what's passed are going to be 2 different things, but it's going to be a lot easier to eliminate things on the high wage earners than it's going to be on, quote, average Joe. So I really expect this one to stick. Okay. There's a rollback of the estate tax exemption. Even as we speak, that is going to sunset by itself. Is that 2025? I believe it's 2025. So even without a legislation change, the estate tax exemption is going to move back to 3 or 3.5 million, and that's going to expose a lot of our individuals. And again, I wouldn't be surprised if they fast forwarded that, because again, politically, it's going to be easier to deal with the top 1%, top 5% of individuals than it will for others. And then obviously increased marginal tax brackets and capital gains taxes plus surtaxes. That's not counting state income taxes. Right? So some of our clients in high tax states have marginal brackets, including taxes exceeding 50%. I'm going to share with you in a little bit a historical tax chart that shows where our taxes have been. And historically, we're in a very low tax environment. So it's really, again, something that we should be paying attention to. All right. And so if, as I alluded to, if tax rates go up in some form or fashion, then that actually makes the taxable equivalent yield in life insurance that much better. And so especially when you're solving for an accumulation type design, something that might be funded at a maximum non-MEC level so that we can stay underneath the limits that the IRS has to make sure that we can get money out tax-free from an insurance contract. Well, last year, December, so that's a year ago, December, Congress gave us a gift. I actually did a coach's corner on this called the Christmas Miracle. And so the tax code that governs life insurance is called 7702. And so they made a tax change last December that made accumulation structures much better than they had been. And the punchline of that is that we can put in somewhere between 30 and 300% more money inside of a life insurance contract under these new rules than we could over the old rules. And if you're thinking, well, why is that good that I can put more in? Well, if you can put more into a smaller policy, that means that your cost drag is actually smaller. So for example, if I was putting $10,000 a year away before, and I needed to buy a $400,000 death benefit, for example, and now the new rules make me buy only a $300,000 policy, well, now I have $100,000 less insurance, which means I'm being charged for $100,000 less insurance, which means that my cost drag is smaller and my net yield is higher. And so I'm going to show you a little bit about that today. But again, that's part of why I think we might be in one of the best scenarios that we've seen as taxes go up, but the efficiencies of these products are increased at the exact same time. Okay. And so to that end, another opportunity that's related to that is these backdoor Roth conversions, right? Roth IRAs are close to the single best vehicle to accumulate wealth, right? The single best vehicle is what? An HSA account. Why? Put tax deductible dollars in, grows tax deferred, and can come out tax free. That's the only vehicle that you get all of those, all 3 of those, right? Roth IRA, after tax dollars, and tax free distribution. Well, if we use a LIRP, life insurance retirement plan, we're overfunding a policy, we're using after-tax dollars, getting tax-free distribution. Is that as good as a Roth IRA? Not strictly speaking, because we have to pay more for the life insurance than the Roth IRA because we're buying the insurance umbrella. However, there's many limitations for a Roth IRA, aren't there? Including how much money you can earn in order to contribute to 1, and then how much you can ultimately contribute on a yearly basis. And in an alert plan, there's no overall maximum to the amount of money that can be put in. We have to follow insurable interest laws and the like, but we have clients that put $50,000, $100,000 a year or even more into those structures. And by the way, those structures are favored and utilized by the majority of Fortune 500 companies to fund their non-qualified deferred compensation strategies. And so if the Fortune 500 company understands that life insurance can be a good place to accumulate wealth, we probably need to understand that too. I can promise you that that company doesn't just love what insurance is, they love what it does. And being able to create supplemental tax-free retirement for our best clients and for their best employees can become a very important thing, and something we're doing every day sort of with our clients, outside of the Fortune 500. Anything else to add there?
Who do you think would be the best fit for the LERP strategy in terms of clients, maybe even business clients?
For sure. Yeah, great question. So, I mean, first of all, if you have a LERP strategy, that means that you have some disposable income, right? So that means you're probably a high wage earner in some way, shape, or form. Usually those people that end up implementing this type of strategy have maxed out their qualified plan to the extent they can. Sometimes they want to put more in their qualified plan, but maybe they're top heavy. So if you've ever had any clients that have gotten that check back at the end of the year for $2,000 that says this can't go into your retirement account because of means testing, those would be perfect people. Would also be those people that don't qualify for a Roth IRA or already have but would like to put more money into it. So the first part of it is we have to have disposable income. The second part is we generally need 15 years or longer of a maturation period, because as much of a fan as we are of these accumulation structures, mathematically they're inefficient for a number of years. It usually takes 5 to 7 years to actually break even in those accounts. And so you really need a 15-year, 20-year horizon. And when you have that, you can get the cost of insurance down under 1% annually. Yes, you can get it down to under 1% annually, which in my opinion, and you're going to see taxable equivalent yields, if we can keep our cost drag at 1% or less, we're doing a couple things. Number one, that's probably equal to or lesser than a wealth advisory fee. Number one, everyone says that insurance is so expensive. Well, what if it's the same cost or less than the advisory fee? Is the advisory fee expensive? Okay. Secondly, then, to the extent that we only have a 1% cost drag, our best clients who might be in a 30 or 40% tax bracket or maybe higher in the future, what's that taxable equivalent yield? And I'm going to share that with you, but what you find is that the cost of taxes can actually far exceed the 1% cost drag inside of the insurance contract. So it's something to really pay attention to, including the designs. They have to be put together appropriately. They have to be managed appropriately. So I would say those would be the best candidates. Did I miss anybody in your view?
I think business owners as well, especially, again, if they have maxed out qualified accounts, or if they're looking to maybe carve out something, for the executive team. Again, these are non-qualified plans, so you can, quote unquote, discriminate. You don't have to have the same benefit for the entire of the company, and you can carve this out for the executives, for the business owners, who a lot of we've seen, anecdotally, a lot of times that over the last 2 years in this pandemic, a lot of businesses have actually made out quite well. So they're looking, what to do with this extra cash, extra earnings. Yep. They maxed out qualified accounts. They can't contribute to Roth IRA. So when they hear about this life insurance and retirement plan, which has a lot of attributes of Roth IRA, and there's no limit to how much money you can put in. We've done some cases where we have, $100,000 annual premium coming in, and once they hear that concept, it's almost like a no-brainer.
Yeah, no, I completely agree. And since you brought up the business owner class and alluded to the idea of, where the job market might be, this type of vehicle on a discriminatory basis, being able to pick and choose who you put it in place, right, can be a very great attraction and or retention tool through the employment process, trying to attract somebody. Well, what are you going to do for me because I've got 4 other offers? Well, what if I do something special for you in this non-qualified deferred compensation structure? Or what about your key salesperson that's generating 30 or 40% of the revenue inside of that business? What if that person leaves? Well, what if we could handcuff that person with something like this, which is effectively what the Fortune 500 companies are doing as well. So that should give you a pretty good idea who should be involved in that kind of structure. Okay. Now here's a piece that Prudential put together that I really like, talking about that 7702 on how much more premium. So you see, for children, you can put 300% more than you used to be able to put in.
By the way, Rod, just for the audience, this is a cash value life insurance. Could be index universal life, could be a variable universal life, and it's being used more of as a really a veneer to get a tax advantage. We're funding this under the MEC guidelines, so the distributions would come out tax-free, right?
That's exactly right. And in fact, thank you for that distinction, because when people think of life insurance, they usually think of term insurance. And term insurance is effectively commoditized, and anything that's a commodity, you want to pay the least amount in for the largest amount of death benefit, right? So we're going to quote, we're going to take the lowest rate, and that makes sense. When you're instituting a LIRP or an accumulation design structure, you take that and flip it on its head. What we really want is a maximum contribution with a minimum death benefit. And that's how we can keep the costs low. And that's what this is alluding to, is that we can buy less death benefit than we had to before. And so the average client that might implement this for us might be somewhere between age 30 and 50. And so if you're 30 years old, those people can put around 150% more per death benefit dollar than they used to. And at 50, that's roughly, call it 60%. And so again, this has just gotten better. And so if you haven't looked at these designs in some years, you really ought to look at them. I have a couple of case studies that I want to show you as well, so you can see how powerful this really can be. Okay. So what happens if the estate tax exemption gets reduced? As I indicated, it's already sunsetting. There's that 2025, right? It's going to 5 million. I misspoke, said 3.5 million. But even without legislation change, this is what's going to happen. And so there are going to be some people that are not subject to estate taxes today who might be subject to them in the future. And then also it's worth noting that we're talking about the federal estate tax. Many states, including Minneapolis, has a state estate tax. So even if your client is not subject to the federal tax, they may be subject to the state tax. So we want to be paying attention to that. One of the best ways to pay for one of those taxes and to put liquidity inside of the portfolio is to utilize a second to die policy or a survivorship policy that insures two individuals on one death benefit. By the way, much like that term structure, what we want to do there is we want to pay the least amount that we can to get the largest death benefit. So when we're doing death benefit structures, we want to put the least in to get the most. And then once again, if we're doing accumulation structures, we want to flip it on its head. And we want to put the maximum into the smallest. And so it really does make a big difference. And I call that policy efficiency. And by the way, if you look at, say, a whole life insurance contract, just straight up, a whole life insurance contract is not the most effective way to create a death benefit per premium dollar, because you've got to pay more money than would be required to just support the death benefit. Nor is a whole life insurance policy the most effective to create a death benefit or make that a cash value. And so effectively, if you graft life insurance this way, you've got death benefit here and you've got cash value here, whole life insurance falls kind of directly in the middle. And what I like to do is I like to push the designs out to kind of declare why we're using it so we can have the best math. Because at the very end of the day, you may really need to touch a heart to implement insurance, and I believe that that's true. So we have to deal with emotions. But once we've overcome that, it's really a math equation. And the reason why so many clients buy from us is the math equation of the insurance is more favorable perhaps than the math equation of where their money might be. And that's why we call it that asset class. And so many advisors are ignoring the asset class, and we want to educate them that not everybody needs this, but understand who does and how to make it as efficient as possible. And that's what we're hoping to be able to share with you today.
Also, just a quick comment. We already talked about possible elimination of backdoor Roth conversion. So now if we have our best clients that cannot do Roth conversions and traditionally have been accumulating their assets inside traditional qualified accounts like IRAs, 401ks, etc. Now you have a combination of reduction in federal estate tax limits, and also the non-spousal beneficiary stretch has been also eliminated, where you have to basically empty that account in 10 years.
Correct.
So all of a sudden, you could be looking at potential tax bomb to the beneficiaries. So this is even more attractive right now to start utilizing some of these life insurance strategies inside maybe a revocable trust.
Yep.
Even before the client hits the RMD age, you can start, moving some of that qualified account into second to die type of products to maximize tax-free legacy. Make sure it's not included in your estate because it's owned by an ILET. And these strategies, quite frankly, makes a lot of sense, even if you don't necessarily, maybe find yourself inside those tax situations. It's just a nice, efficient way of passing on legacy and maximize dollars to your beneficiaries.
Yeah, there's no doubt about it. Listen, do I believe that an IRA is a wonderful vehicle? Yeah, I do. I believe it's wonderful. You know why? Because you get to make that contribution, get a tax deduction today. It feels wonderful. It gets to grow for 20, 30, 40, or 50 years without taxes. Again, feeling wonderful. But then what happens? The tax man cometh. And now we're distributing and every single dollar fully taxable. And to Andrew's point about the 10-year spend down for non-spousal beneficiaries, think about me as a good example. The last asset that I would want to inherit would be an IRA. Why? I'm 44 years old. I inherit an IRA. What am I going to have to do? I'm going to have to spend it over 10 years. Well, cry me a river, Rod. I mean, just be happy that you got money. Okay, I get that. I do. But efficiently, this is very bad news for me mathematically, right? Because what I have to do is I've got to take that on top of what? My already earned income. So every single dollar that I'm going to take from that, I'm going to pay at my highest marginal bracket. That is very inefficient. And so I wonder if you have any clients, you might have the parents that may not have uber wealth, but maybe they have a physician as a son, and that physician in the top tax bracket, and it's important to them to leave the physician dollars, their son or their daughter. And again, it's like it's kind of amazing to me sometimes. People understand that they pay taxes and then they complain about it. But what's interesting is I don't know that they always think about that as being an actual cost or an expense, right? I hear them saying that insurance stuff is too expensive. I don't hear clients say my taxes are too expensive. I believe that they are too expensive, and I think they're getting higher. And that's, again, why we have to understand how we can effectively use an insurance contract in the right way, not in a commission maximization strategy way, in the way that it's most efficient for the client and complements the other portfolio. That's the other thing. We don't stop putting money in other places. Anything else to add there?
No, I think we're good.
So when we're transferring wealth, I like to use guaranteed universal life or guaranteed secondary, guaranteed survivorship universal life, because I effectively view that as lifetime term. There's no such thing as lifetime term insurance, but if I'm focused on death benefit, I want to put the least amount in I can, and I like guaranteed structures. And so again, as we've discussed, I'm going to show you a case study that when you look at how much money you put into these contracts and what we get back out from the death benefit, you can calculate the internal rate of return. And that internal rate of return can be very, very favorable. And when we have these guarantees from these insurance companies, they're effectively professional money managers and professional risk managers, and they guarantee these death benefits. And so that means that the death benefit return is guaranteed based on the claims paying ability of the company, non-correlated to the market, and income tax-free to the heirs. To Andrew's point, we could place it in an irrevocable trust or maybe have it owned by an adult child, and we can effectively remove that from the estate tax as well. And so any client that's exposed to income taxes, and certainly income taxes and estate taxes, must consider whether or not insurance should be part of their portfolio. And I believe a lot of times those people are not considering that. Part of it is that they might be biased against it themselves. Another part might be that the advisor, him or herself, might be biased against it, right? And so if that's you, I understand that. Hopefully I'll help enlighten you here today and show you how it can be done correctly. Okay. So again, we've kind of hit a lot of these, but what do we talk about? Well, the majority of the Fortune 500 companies, as we talked about. It's my belief that 99% of the most successful people that I talk to aren't aware that some of these strategies exist. They're just not. And so that's what we talk to them. I like to ask them how much of your retirement income is going to be in a tax favored position, right? If you could put more money in your 401k, would you? Right? Some of the best cases I've personally found have been effectively in the physician class, where the wealth advisor put together a 401k and a cash balance plan, and the client's really, really happy, and they've got to put $100,000 away pre-tax. I think it's awesome that you can put $100,000 away pre-tax, but we're creating a pretty big bomb for that individual in the future, aren't we? But in either event, the point is sometimes that 100,000 pre-tax, if we ask that doctor, would you put more in if you could? They go, yeah, I would. Well, how much more? Well, I'd put 50 grand more. Well, that 50 grand should be considered here. By the way, a lot of times that extra incremental $50,000, in my opinion, by default ends up in a brokerage account. I have no issue with a brokerage account whatsoever. I think they're perfect for the job that they're intended to do. But a lot of times that 50,000 is money from 20 years from now. So why isn't it in a brokerage account subject to capital gains? And maybe it ought to be in an insurance account that is not subject to capital gains, and it might be better off. And by the way, maybe we should just split the difference. Maybe 25,000 a year should go in the brokerage account and $25,000 a year in the insurance. Well, that's something we can really consider if we're actually considering the insurance. If we're not considering the insurance, then we just ignore it. And if we ignore it, have we really brought the best solutions to the table, right? And that's kind of what we want to impress upon you. All righty, so let's get into some case studies. So before we do that case study, I just want to show you historical tax rates. Can you see this, Andrew? This is up.
Maximize just a little bit.
How about this? How about here? Top federal income taxes on regular income and capital gains since 1916. So take a look at this. What this goes is year by year from 1916 on, shows the top rate on regular income over what amount of money. So take a look at these highlighted years. So this is after the war. So we had a 94% top tax bracket for those earning 200 grand a year or more. Now I recognize $200,000 a year in 1944 was probably $1 million or so. Okay, so it didn't affect everybody, but could you literally imagine that you're earning $1 million a year and the last dollar that you make, they take 94% of? I mean, that to me, it is mind blowing. Do I believe we'll ever get that high again? No, I don't believe we will. But guess what? We were at a 94% top marginal bracket. Well, what about in the 70s? What happened here? Well, now we dropped to 70% at the same 200, but is that really the same 200? Probably not. That 200 is probably $500,000, $600,000 a year. How many clients do you have right now that earn $500,000 or $600,000 a year? I bet you have some. Could you imagine those individuals being in a top tax bracket of 70%? Right? Again, to me, it's amazing, right? Do I think we're going to get to 70% again? No, I really don't. But we were there, and we were there for a long time. Look at that. We were at 70% for a whole decade. Right? Well, now look where we are. Of course, this ends at 2011 and on, but we're still in the 30s effectively, right? High 30s. So we've been in the 70s, we've been in the 90s, we're in the 30s, we have this huge deficit, we have more spending coming. Something is going to have to give. I don't know what, when, where, or how. Something is going to have to give. If I'm a betting man, I do think that we're going to approach 50%. I really do. And I think we're going to approach 50% not counting our state taxes. And so I think a lot of our clients are going to be approaching 60%. And our clients in California, I think they're going to be approaching 65% at their top levels. Now, again, there's a certain thought, Crimea River, you made all that money. But again, these are our clients. And by the way, our job, last I checked, was to put our clients in the most favorable position possible. So if you have clients that are likely, in my opinion, to be discriminated against with taxes, now that's a different story, and that might be political, and I don't want to go there, but I think that's a form of discrimination. that you would take that kind of money. Now, that's just a personal opinion, certainly not the opinion of U.S. advisors or anything else, okay? But knowing the wealth advisors that usually work with us, there's maybe a reasonable chance that you agree with me on that. But I really shouldn't have brought that up even, even from the get-go. Would you say anything else about this, Andrew?
No, betting man, with the deficit gap, not the deficit gap, but with the revenue gap that we have and the speed that we're printing the money, that revenue will have to come from somewhere. And it will have to come from, at first probably 1%, but then it will have to come down to, 3, 4, 5%, and then the clients that we work with, they will be impacted by this. So knowing these strategies, bringing that up proactively, because chances are, like you mentioned, 99% of the clients are not aware that you can have a Roth, quasi-Roth, non-qualified plan out there that has no limit to how much money you can put in, has no limit on income before it gets phased out, and it's flexible and the money can come out on a tax-free basis. Clients, chances are, will not come knocking on your door and say, can I have some of that 7702 policy? No, this is something that you have to proactively bring up, and we even have worksheets that itemizes how much of your retirement assets are in qualified, after-tax money, pre-tax money, and then tax-exempt. And on the tax-exempt, you're really looking at, muni bonds, Roth IRAs, and then cash value life insurance.
Yep, that's about right. All right, so let's take a peek at what taxable equivalent yields might look like, and I'll pair this back together as we go through the case studies. But take a look at this sheet. So this right here is a tax-free return rate right here. So let's just take a 5% return on a tax-free basis.
Maximize it just a little bit, Ron.
Okay. How about this?
Better.
So here's our 5% tax-free return. In a 15% bracket, we have to get a 5.88 return to net out 5%. This chart ends at 40%. In a 40% bracket, we need 8.47% gross to pay taxes to get 5% net return, tax-free. And so what you're going to see in a minute is that if I had a 6% return inside of an insurance contract with a 1% cost drag, I would net out 5% tax-free. And so I only need 6 in the life insurance contract. I need 8.47 here, right? And so again, people aren't really thinking about that. And the cost of taxes can be very significant. So that's a little bit of a sneak peek. Now, before I go into the actual numbers, I want to show you this screen. Okay, so this is a term versus permanent insurance chart. And effectively speaking, down here, this is your cost of insurance. In a purely insurance basis called annual renewable term, the cost of life insurance exists on this line, which means that every single year it gets more and more expensive as we get closer to life expectancy. But people don't generally buy it that way, right? They buy term insurance for specific durations of time. And every time they buy that, they have to pay a higher premium for the rate lock, 10 years, 20 years, 30 years. Well, if we use a guaranteed universal life, whether on a single life or joint life, that's that lifetime term that I described, which says that it's going to guarantee that forever or out to 90 or 100 or 110 or 120. And again, when we're dealing with distribution or wealth transfer vehicles, I want to give the company the least amount of money I can to get that death benefit as high as I can for as long as I can. And I'm going to show you one of those structures. And the second structure I'm going to show you, once again, flips it on its head, which is what we're seeing up here, the IRS code 7702. Now this says VUL, but it doesn't have to be. And in fact, I'm going to show you an IUL, Indexed Universal Life. That doesn't matter. What matters is you see this line, a MEC line and non-MEC line. What we do is we solve in reverse and we put as much money as possible, way more than it costs the insurance company to insure us. Why do we do that? Because every dollar that we put in there above the cost comes down and it forms this cash value. And so I call that the engine. So if we have one of these, we have to decide what engine is running this. We can have a fixed engine run it, which is going to be like a universal life or a whole life contract, and it may be appropriate to do that. Generally speaking, they're going to credit 3 to 4% interest in today's environment after they take out costs. We can go directly in the market if we want to, and we can put together an allocation similar to what we would put inside of a 401k or a Roth or even your brokerage account, and we can get what we get, right? We're going to get the up years, we're going to get the down years. And then we can also go into an indexed, which is really what I prefer, because we go back to who does these types of things. We talked about is people with discretionary money. Well, those people generally have large allocations directly in the market already. And so this asset class gives them tax diversification, and then it also gives them investment diversification at the same time. So I do favor IULs, but what I want you to hear is that an engine can still run this beautiful vehicle, and there's more than one engine. And so just understand that we can do it a couple different ways depending on what makes sense. Before I go into the actual numbers, Andrew, anything else for you to share here?
No, and if you would like to see the difference, we can certainly illustrate both ways. I would say maybe with younger clients, especially somebody in their 30s, early 40s, maybe as a rule of thumb, VUL would make maybe a little more sense depending on their risk tolerance. But as they get closer to retirement, I think IUL, Index Universal Life, makes a lot of sense.
Yep. And if we ask 10 insurance guys, they'd all be a little different. You ask every advisor, they're a little different. You ask every client, they're a little bit different. My strategy is let's talk about conceptually how it works and why we ought to consider it, and make sure that is appropriate. If we check those boxes, then the next question is, how do we want to fund this then? What engine do we want to use, right? So 99% about what you're going to hear here is going to be applicable whether you used any of the 3 engines. Okay? And sometimes maybe you do 2 engines at once, right? Especially if we have a $100,000 allocation, maybe we put 50 in one engine, we put 50 in another engine. I certainly do like that as well. All right, so I want to start with this snapshot, because if you've ever looked at illustrations, they can be pretty painful, especially if you're trying to look at multiple illustrations and trying to compare them. So the first thing I'm going to do is kind of walk you through this summary, and then we'll dig in a little bit deeper. All right, so what I've done here, as you see, the first thing I've done is I've solved for $1 million of death benefit on a standard plus basis with John Hancock. And the reason I use standard plus is because John Hancock's standard plus is effectively the standard rating in the industry. The short reason for that would be that John Hancock is just mammoth, and they can and do take more risk effectively than other companies do. And so they've priced their standard plus rate to effectively be other carriers' standard rates, right? And so understand that that's what we're looking at. Understand you have to qualify for any of these things, right? So to that end, there's ratings that are better, which means that the pricing will be better, and there certainly are ratings lower, which would mean the converse. So I'm showing standard plus. This policy with John Hancock is guaranteeing the death benefit into the low 90s. I'm going to show you that, meaning that inside of these contracts, you have 2 schedules. Many of you are probably aware of this. You have the current schedule and you have the guarantee schedule. And so the current schedule says, here's what we're currently crediting in interest, and here's what we're currently charging in insurance costs. So this is how we're operating today. And then the guaranteed structure says, here's how we reserve the right to operate. We reserve the right contractually to charge you a maximum insurance cost and to credit you a minimum interest rate. And so when I say that it's guaranteed to the low 90s, I'm telling you that based on the claims paying ability of John Hancock, no matter what happens, as long as we pay our premium, this policy will last into the mid 90s. And then if we get reasonable performance, which I'm going to show you, then it will last forever, right? So it's not fully guaranteed, but it's mostly guaranteed. Anything to add on that, Andrew?
No, I think John Hancock really kind of propelled themselves into the top of the competitiveness, if you will, with this product, which, by the way, still uses 2019 cost of insurance, meaning that this is pre-pandemic. So it hasn't been repriced. It's almost like there's a fire sale because, chances are there will be an announcement coming out soon. So if you're looking to maximize tax-free legacy, tax-free death benefit, and use either full pay scenario or short pay scenario or even single pay scenario, this product with John Hancock Protection UL is very competitive, one of my favorite. And now, if you have a client that is 65 or under, there's a good chance that they may even qualify for their accelerated underwriting, which may not require medical records or even exam in some situations.
Yeah, thanks for adding that. And so, yeah, we said it runs to 120 at 4% return. So, which is
current rate is 4.35%,
right.
But
Yep.
we like to illustrate it even more conservatively.
Yep, exactly right. So here's how this looks. So what I ran is I ran a 60-year-old couple, a male and female together on a second to die structure. And then just to be able to show you guys, I ran just the man alone and just the woman alone, right? And so what you see here, and we're going to start with the 60-year-olds and then I'll go to the 70-year-olds because I wanted to discuss the cost of waiting, right? If these strategies make sense, we got to start talking to clients as early as possible. Not only does the pricing better, but health is better. Okay, it's anecdotal, but I've been in business 20 years and I'll tell you there's a distinct difference on average, anecdotally, between clients in their 60s and clients in their 70s. There is often a distinct step down in health. And part of why when you really understand these things and when your client really understands these things, I know that they really understand them when they ask me this question. How can they do that? How can they do that? And they can do that because you have to qualify for these things. You want to give the company $1 million a year and you can't just give them $1 million a year. You have to qualify to do that. They have to accept you, which means they're going to determine what kind of risk you are. And what that really means is you've got to be in good health to get this stuff. And that's in part why the numbers look so good. So I'm sure you've been looking at the numbers. Let me tell you what these numbers mean. So this 60-year-old couple needs to put $11,600 into this policy to guarantee it into the low 90s and to run to 120. By the way, why 120? 120 is the actuarial age by which all of us will be dead. So that is considered a lifetime guarantee according to our actuaries. So that's why 120 seems like a random number, but it isn't. It's the age that all of us are supposed to be gone. Okay. So if I have a husband and wife, I need 11.6. Just the husband alone, I need 18.7. And just the female, I need 15.4. So if we're looking at this in a traditional way, we go to our 60-year-old client and say, you need to pay me $11,000 a year for life insurance. And they go, are you crazy? Are you out of your mind? I don't need any life insurance. And I don't need a cost of $11,000 a year either. That's not what this is, folks. It's not that at all. Okay, this is an $11,000 contribution, and that contribution is supporting an asset worth $1 million. So on day one, we know two things on this structure. If I'm a husband and wife and I'm paying 11.6, we know two things. I'm going to contribute 11.6 every year. And when both of us die, they're going to pay my heirs $1 million income tax free. They might pay it estate tax free if it's owned appropriately. So we know those two things. What we do not know is how many times is the client going to have to contribute 11,600 into that account. If they do it one time and it turns into $1 million, guess what we have? The single best performing asset they've ever had in their entire portfolio. That insurance stuff is garbage, right? Well, yeah, it's garbage unless you turn 11,600 into $1 million overnight, then it's not garbage anymore, is it? Now, to be fair, the professional risk manager underwrote you, so the likelihood that you're going to die in that first year is very, very low. But if 1,000 people put this in place, one of the couples is unfortunately getting in a car wreck. Forgive me for saying that. And the company is indeed paying $1 million. And what's the return on that? Now, that's not likely. What's more likely is these people are going to live sometime, right? The professional risk manager says they're going to live because they were underwritten. So look what happens if we go out 20 years. So over 20 years now, they've contributed 11.6 for 20 years, right? 11,600 times 20 years, $232,000. Again, in the old way of looking at this, are you insane? Why would I pay $232 for life insurance I don't need? Go, no. You're contributing $232 for life insurance you want. Why? Because if you both pass away in 20 years, the life insurance returns 12.51%. Guaranteed by John Hancock, non-correlated to the market, and income tax-free to the heirs. So now you got two 80-year-old individuals. right? Now, is it possible that one or both would live beyond 20 years? Yeah, absolutely. So what if they live 30 years? So now over 30 years, they've contributed 11,628 for 30 years. They put in $348,000. That's what they contributed. What they get back? $1 million. What's my return? My return is 6.14% income tax free over 30 years. These two people are now 90 years old. That is a heck of a good return in my opinion. Right? If you invest this 11.6 somewhere else, what kind of return are you hoping to get for them over the next 30 years? I mean, as 60-year-old people, are you going to be invested in an 80-20 portfolio for equities and bonds? Are you going to be in a 20-80? I mean, what are you really going to expect to achieve? 7% return? I think that's probably okay. 6% maybe. But look, we have 6.14 tax-free. If we peek at our taxable equivalent yield, what tax bracket are these clients in? I don't know. Well, even if they're in a 31% bracket, they have to get 8.7% in your portfolio to achieve a 6% tax-free return. Now, am I saying that's impossible to achieve? No. For planning purposes, I think it might be a poor plan to think that we're going to achieve that. But what I'm really impressing upon you is you and your client ought to consider whether this 11.6 should go on the investment account or go into life insurance. And what I would suggest to you is if these two individuals die within 30 years, the life insurance contract probably outperforms your portfolio. And certainly if it happens early on. How long is it going to take you to turn 11.6 every year into $1 million total? Because the insurance company can turn it into $1 million right now. And that's the power of insurance. And if your client gets that, they ask you, is that right? How can they do that? You say, well, they're going to take your blood. That's how. They're going to take your blood. That's how. And they're going to take your urine and they're going to go look at all of your medical records, right? And they're going to ask you a bunch of medical questions, right? And they're going to, that's how you're going to do it. You have to qualify, right? Any comments from you on that, Andrew?
Yeah, I mean, also in income planning, how many times have you heard that, clients want to have cake and eat it too, or eat cake and have it too, meaning that we're looking to draw retirement income and we also want to have the assets available for beneficiaries in the form of legacy planning.
Yep.
And that means that now we have to withdraw less money if we want to also have so-called principal maybe available to beneficiaries. So by maybe taking, if $1 million is what we're talking about, taking distributions and funding life insurance, whether it's single life or especially second to die, replacing that $1 million retirement asset for tax-free legacy money to the beneficiaries, it would alleviate more money to be available for income for your clients while they're alive.
It's a very good point. I like that. So here's why I put 70-year-olds here, because I wanted to compare and contrast how drastically different these numbers are if we wait 10 years. Now understand that we waited 10 years, but we didn't drop down any health classes. So this means we're 10 years older, but we're still as healthy. Now listen, Andrew and I are in pretty good shape and him better than me. But for planning purposes, if we go out 10 years from today, it is not likely that Andrew and I are going to be in better health 10 years from now than we are today. It's not likely. We're probably going to be in worse health, hopefully not markedly worse. When we get to 60 and 70, that's a bigger difference because we're still relatively young. Look what happens to the 70-year-old couple. Now they need $20,000 a year. So our old way, there's no way we're going to get this done the old way because you got to be crazy. 20 grand a year for $1 million I don't need. But by the way, some 70-year-olds still implement this. Why? Well, what's our 20-year internal rate of return? 808. Is that as good as 12.51? No. But how old are we here? We're 90 years old right here. Here we're only 80 years old. Look at this is actually the 90-year-old IRR, right? Why is the 90-year-old IRR less efficient on the 60-year-old? It's because I got to pay 10 more years of premium. So in a certain way, right, this is age 90 is better than this age 90. But I also ran out 30 more years here, and you got a 3% return. You're 70, you're telling me that you'll pay me at least a 3% return on a guaranteed tax-free basis over the next 30 years. I mean, listen, I know what's going on with interest rates right now. If this was not called life insurance, but I could guarantee you over a 30-year period of time that will give you a 3.1% income tax-free return, would you put any sleeve of your client's money in it? What if I told you that I have a 20-year product that is guaranteeing you to not pay less than 8.08% on a tax-free basis? Would you put any of your clients' money in it? See, that's where we get into this, where they go, that insurance stuff is garbage. We go, no, not if you do it right. Not if you do it right. And that's what this is. Okay. So I'm going to move to the accumulation strategy. We're 150. Apparently, I don't know where the time goes, but I want to go to this accumulation strategy. So again, if this intrigues you, if you want to know what your exact client numbers would look like, or maybe your situation, reach out to Andrew or myself or George Steele on our team, and we're obviously here to help you. That's what we do. We help advisors help their clients, and we all win together. So the second thing I want to show you, again, is the accumulation design. So now what I've solved for is I've said, if I have a $50,000 premium contribution, and I do that just for 7 years only, and then I stop. So this is designed that I can't put any more money in this thing after 7 years. So the IRS told me how much money I could put in. I can't put anything else in. And now I'm showing the difference between a 35-year-old and a 45-year-old. So a 35-year-old taking this same premium structure has to buy a minimum death benefit of $834,000 according to the IRS. That's the least amount he has to buy. If he buys $833,000, we've ruined it. It's become a mech. Okay. The 45-year-old, the same premium structure, he doesn't have to buy as much. And that's because he's closer to life expectancy. So he's got to buy $706,000 of coverage. Of course, his rates are higher because he's 10 years older, right? And so what I have going on here is we get out 20 years, what kind of return do we have on our cash value? And what we have in this case is a 6.14% return on cash value, which is accessible income tax-free, as we described. So that person now 20 years in is only 55. One of the things we didn't mention about the Fortune 500 companies and the idea that this is non-qualified, well, part of what that means is there's no 59.5 rule. So a lot of our clients are actually utilizing this type of structure to bridge the gap to when they can get into their qualified accounts. Some of our best clients want to retire at 50 or 55, and where are they going to take income from? So a lot of times you have them taken out of brokerage accounts, and that may be appropriate. But this can be a great vehicle to take money out of this kind of account, which will come out tax-free and help bridge the gap to when we can actually access. I understand you can get at it early with 72Ts, so a lot of different things that can be done. But what I'm describing to you is many people are just ignoring this as supplemental retirement income, and they really ought not. We get out 30 years when this person is more likely to retire at 65. We have a 6.61% return on an income tax-free basis utilizing an indexed account. And then again, I'm just showing you that if you wait, we effectively get punished for waiting, right? When we wait, our numbers are not as good, even if we're as healthy. So again, what we're impressing upon you is if you like any of these strategies, if you want to learn more about them, we got to bring them to clients basically now, right? There's always tomorrow, and if we wait till tomorrow, something always happens. Two types of people call in and want insurance, in my estimation, in 20 years. The first person that calls in and wants insurance is because, unfortunately, they have experienced a significant loss with a loved one. Somebody died or became disabled, and they go, oh my gosh, I got to get some coverage. Well, when that call comes in, we can usually help that individual. They're highly motivated, and we can help educate them, and we can protect themselves. There's a second kind of person that calls in, and that person who calls in just went to their own doctor, and their own doctor gave them some kind of diagnosis. And now they're calling us going, hey man, I need to protect myself. And guess what the answer is? Sorry, come back to me in 6 months, come back to me in a year, come back to me in 3 years, come back to me in 5 years, never come back to me again because you're uninsurable, right? So if that feels like I'm laying it on real thick, I don't mean to do that, but this happens every single day. People want to get this stuff and they can't get it. And so as advisors, we got to bring this to them as soon as possible. I do want to dig into an illustration real quick here before we run out of time, because I want to show you the downside to this strategy. Okay, I referenced it before. So this is the 35-year-old. You're putting $50,000 a year in for 7 years. That's $350,000 in the bucket. We had to buy 834,000. Am I missing something, Andrew?
If you can maybe just zoom in a little bit.
A little bit more. Let's go here. How's this? Is that better?
Yes.
All right, 50,000 a year premium times 7 years, 350. At the end of year one, I put 50,000 in. If the client wants to walk away, they can only walk away with 28,000. See, I told you this stuff was garbage. Well, it is garbage in year one unless you die. It's garbage for accumulation. If he dies, 834 is paid, right? Is it a good deal to put $50,000 in and get 834 out? It is. Of course, he's not going to die, right? That represents a 43% loss on the internal rate of return. So Rod, you told me I'm going to get 6% in this thing. I lost 43. Yeah, you did. It's because it's front weighted in acquisition costs. They have to pay a commission. They have to pay an underwriter. They have to pay your doctor. They have to pay a nurse, right? So it's higher fees up front, which is why people go, that insurance stuff's garbage. Well, it's not. It takes us out here to year 5 before we have a net return. So at year 5, now I've actually earned 1.2%, but I was earning like 6% in this thing. And so the difference between what I earned and what I actually got was what? All of those insurance costs. So I call this the price of admission. But look what happens over time. Look at 20 years out. Now that has raised to 6.14%. So we put 350 in the account. We've got 970 in cash value that we can access without taxes. And by the way, our death benefit has now grown to $1.5 million. Why? Well, it's grown because we have so much cash in the policy that the IRS is requiring the death benefit to go up because they have a backdoor testing that's roughly called a corridor. There has to be a relationship between death benefit and cash value. And so as cash value goes up, then the death benefit goes up. And so this guy now has supplemental retirement income of $970 at age 55. If we go down to 65, it's grown to almost $2 million. So we're talking about projecting a 6.5% return on a tax-free basis over 30 years, which is going to turn his 350 into $2 million without taxes whatsoever, right? And that's the real power of this thing. So Andrew, we got 3 minutes left. What do you think we should spend them on? You have a couple of
from
pieces.
your experience, if you could maybe just share, when is the best time and what's the most effective way of bringing up this conversation with clients?
What I would generally do is I would have some sort of conversation that went like this. Hey, I was thinking about you recently. In light of the current economic climate and the very likely increasing tax environment, we're being more proactive with our clients around tax strategies than we have in the past. I'd like to get you into the office. I'd like to get you onto a Zoom, and I want to be able to discuss with you a couple of these things. And then what I would do is I would describe similar to what I've presented here today. How much do you understand about what's going on with taxes and in Congress? Here's some of the things they're thinking about. Does that concern you? How do you feel about the taxes that you're paying? And when we fast forward 20 years, do you personally believe your taxes will be higher or will they be lower? Would you then like to consider a specially designed structure that could help mitigate some of that? That's how I would definitely bring it up. And if you're very comfortable doing that, that's wonderful. If you would like to perhaps utilize me to do that with you on a joint work basis, that's a lot of the kind of work that I do. So if you want to go through that and say, I know enough to be dangerous, but I use a partner, and this is all that he does all day, every day, and he's just going to educate you, then that would be another way to go about doing that. Okay. All right, so our next Coach's Corner is the 17th. Again, we are going to be describing how you can bring on 12 new clients inside of 3 strategies and generate $100,000. That's going to be our topic. We have a toolbox that has all of our recordings, a lot of beautiful material that can help with scripts and best practices and a lot of information. If you don't know what that is, you should reach out to us and we'll make that available to you. We have Rod Crandall and Andrew Casilius here. We also have George Steele on our team, and to the extent that you need anything, you can reach out to any one of us directly. Then lastly, Andrew, I'll let you close up. It sounds like you have a couple of pieces that are relating to what we talked about today that you're going to send out to them or make available to them. Is that right?
Yes. So first of all, I want to say thank you everybody that joined us today. Hopefully you found it informative, and hopefully life insurance, again, you don't have to make a 90-degree angle in your practice. Just a little deviation maybe from what you're doing is going to result into big results at the end of the year. And you know, with pandemic right now, there's a heightened awareness of you know, about life insurance. People are looking, people are wanting to have these kind of conversations. And now when you combine heightened awareness about mortality with heightened awareness about taxes, I think it's a perfect combination to have clients engage in these planning conversations with you. So make a habit of reviewing what they currently have, asking questions, and we do have materials to help you with those conversations. Once we have this recording available, I will be sending out an email with the recording, and I will attach those resources as well. So stay tuned for that.
It's beautiful. So I appreciate all of you, and we'll look forward to seeing you on February 17th. So make it a great day, everyone.
Take care.
Goodbye now.